Hello everyone, and welcome to another episode of Daily Gwei Refuel, where we recap the latest news in the Ethereum ecosystem. I'm your host, Anthony Sassano, and today is 20th of February, 2024. Alright everyone, let's get into it. So just before we get into it, actually just wanted to make note that I changed a bit of things with my microphone setup, a bit of settings around. So hopefully the audio quality is better and the sound isn't too low or anything, but yeah, that will probably be the explanation if the sound levels that you usually listen to the refuel on have changed. It's because I've actually changed my setup. It's got nothing to do with your own kind of setup. It's all me. So just let me know if there's any issues with it, but I tested it pretty extensively, so it should be fine. But yeah, let me know if there's any issues there, if it's too loud or too quiet or anything like that, and I'll see what I can do from there. Anyway, moving on to the news over the last 24 hours. So lots to get through as usual. Kicking off today with a post from Mike Nutter and Alex Stokes here. I think those are the two main authors on this post. That was posted 4 days ago, but it was only shared on Twitter today, and it's called the Rollup-Centric Roadmap 2024 version. And essentially, Mike describes it as a modern rendition of the Rollup-Centric Roadmap that Vitalik obviously posted about quite a while ago now. The original Rollup-Centric Roadmap, I think, was posted 4 years ago or something like that. No, over 3 years ago, as Mike notes here. He says it's been over 3 years since Vitalik put pen to paper, voicing a rollup-centric Ethereum roadmap, and there's obviously been a lot of changes in the interim, but there hasn't been kind of like a modern version of the rollup-centric roadmap kind of put out there, and that's where Mike and Alex come in to basically put this together and have this as like basically a living and breathing document, I think, of basically following along with the changes happening on the rollup-centric roadmap for Ethereum and obviously everything going on the L1 side of things. There's actually a lot of stuff in here. I read through it just before. It's honestly really great. I think that the core idea of the rollup-centric roadmap hasn't really changed, right? We're going with like rollups and layer twos generally. I think the biggest change probably is the fact that we aren't just doing like rollup-centric, we're doing layer two-centric, right? Because obviously to be a full rollup, you need to post both your kind of like proofs and data to the same layer, in this case L1 Ethereum, but you can also be considered a layer two if you're a Validium, which doesn't post its data to Ethereum, right? It posts its data somewhere else, whether that be a data availability layer or a data availability committee. It doesn't just post it to ETH L1 there. So I think that's maybe one of the biggest kind of evolutions in terms of kind of what the rollup-centric roadmap actually encompasses. But there are so many other things, right? There are things around MEV consideration, how staking works with regards to the rollup-centric roadmap, censorship resistance, decentralization, all that, and the different stages of the rollups too that Vitalik has also written about in the past. So this post basically aims to just modernize what Vitalik originally posted back in, I believe it was 2020. I mean, they do link to the rollup-centric roadmap here. I believe it was, October 2020. That's what I remember. So, I mean, it's going to be 4 years in October this year since this was posted, and I think obviously we're making a lot of great progress on the layer 2/rollup side of things, but I think that having an updated kind of document that follows along with all the kind of bleeding edge stuff that's happening in the Ethereum ecosystem when it comes to the rollup-centric roadmap is definitely a great resource to have. So I'm not going to kind of go on too much about this because it is just a document that I highly recommend that you guys read, and I think that it's just something that everyone needs to be on top of if you want to be studying Ethereum, studying how it's scaling, and being able to, explain it to other people as well, because obviously Ethereum has a more complex scaling roadmap than some other kind of chains out there. Obviously Ethereum is not trying to do everything on layer one, whereas a lot of these other kind of monolithic chains are trying to do that, and they're I guess by nature easier to explain than the rollup-centric roadmap. But as we know, the only sustainable kind of way to build a blockchain is through the modular approach, and the monolithic approach is not long-term sustainable, and there's no way you can do everything on one layer. And I mean, I say that's like we know it as a fact. I mean, I believe that is the case. I mean, I don't know if we could say we know it as a fact right now. I mean, I personally would say that it's a fact, but there are obviously people who disagree with that, so I'm not going to say like it's a sure thing. But I think that, as the years have gone by, the rollup-centric roadmap and the modular kind of roadmap for blockchains generally has just caught the mind's share of most of the ecosystem. Even though it's more complex, inherently more complex, it's still something that I think a lot of people have a lot of drive to work on and improve, and they really do view it as a long-term sustainable solution for scaling blockchains. All right, moving on. So Tony shared EIP 7623, which is an EIP to increase call data cost. So you guys know that call data right now is predominantly used by rollups to store their data. Now, of course, post Denkun, they're going to be storing that data in blobs or call data. And I think the whole point of increasing the cost of using call data is to basically push push people, push the rollups towards blobs and decrease the overall block size of Ethereum, or sorry, decrease the maximum block size of Ethereum in order to basically increase blob sizes. So essentially, we're basically trading off call data for blobs. At least that's from my understanding here. And Tony kind of describes describes it in his tweet here, where he says, make room for block gas limit and blob count scaling. So essentially, be able to increase the gas limit of Ethereum blocks as well as increase, the blob. The blobs on the network. And call data is definitely, post Denkun, going to be the inferior place to store data because blobs have been specifically designed for rollups. Call data is just like a happy kind of thing that was there that rollups could use, but it really isn't fit for purpose. Blobs are the thing that we're going with, so it would make sense to increase the cost of call data here in order to make that an economically rational thing for rollups to do. Because I did say that, or at least in the short to medium term, until this EIP gets implemented into the network, what can end up happening is you have arbitrage opportunities, or at least kind of like a ping pong between call data and blobs, depending on which one's cheaper, right? And because obviously call data and blobs can be used for things other than rollup data, it can be used for things like inscriptions. We may see spikes here and there, and then we may see kind of rollups, switching between the two, and it just becomes very, very messy. It's not a very clean solution. So that's why this EIP has been proposed here. But as I said, it is just a proposal right now. It only got created on the 13th of Feb, so about a week ago. You can read through it yourself if you'd like to, but both Tony and Vitalik are the authors of this EIP, and I definitely think it's something that will end up going into the network. Maybe, I don't know if it'll be part of Pectra. It may end up being part of like the upgrade that goes live next year. So the Osaka, I think it's called right now, or tentatively named, the one after Pectra. But we'll have to see, right? Pectra's already a pretty stacked kind of upgrade right now. Even the things that aren't included yet, if we just included a few more of those, it's pretty stacked. So definitely keep an eye on that. I'll definitely keep an eye on that for you guys and let you guys know how this is going. But this makes a lot of sense, I think, given that we now have blobs, we'll have blobs in the very near future that rollups are going to be using instead of call data. So there's no reason to have call data be so cheap. And also at the same time, call data is actually too cheap. I think that the core devs have thought about this for a while, that it's actually too cheap for the amount of like resources it uses on the network. So it's really just a resource kind of repricing here. And this has happened to other opcodes on the Ethereum network. This is not, the call data is not the first one to undergo this treatment. And really it's just to basically have, fair pricing. And I guess fair is subjective, but essentially fair pricing for the different opcodes on the Ethereum network so that we can have a more efficient and stable network overall. All right, something that else that Tony shared here is just a screenshot of one of Georgios's cast on Farcaster, where he said, I think somebody will need to figure out how to connect account abstraction with stealth addresses plus hiding payment amounts. Gas sponsorship will let anyone pay for your transaction. Batch transactions will mean you can spend from multiple authorized stealth addresses, solving the fragmentation. And Tony basically shared this, saying that Georgios here is giving us a glimpse into the future. Imagine a world where we have account abstraction plus UTXO-like wallets plus stealth addresses that will provide end-user privacy without requiring any sort of mixing. Now, of course, I highlighted Tony's paper the other day of stealth addresses, and stealth addresses is something that Vitalik has spoken about before as well. But it's basically a way to get privacy without having to do any kind of mixing, whether that be on Ethereum L1 or L2. And I think that eventually it could become the default way to interact on chain. We all know that everything you do on chain today is completely public. There are massive companies like Chain Analysis and Arkham Intelligence that will basically de-anonymize the entire chain. They use a bunch of heuristics, not just the on-chain footprint, but things like, what times you send transactions, where it looks like you live in the world, or do you have a public presence, all that sorts of stuff, right? So that can all be linked, but the hope is that with something like stealth addresses mixed up with account abstraction and UTXO-like wallets, you can get to a point where essentially the default way of interacting with on-chain kind of on-chain things is in a privacy-preserving way without having to use a mixer. Because obviously using a mixer, at least with Tornado Cash right now, it's obviously illegal for US citizens and persons to use that, and it is a gray area for other people around the world. But generally, I would say that mixers require you to actually go out there and kind of like mix your funds. It's not the default, right? Like you have to go to Tornado Cash, you have to put your funds in, you have to basically wait for the whole process to go through and then withdraw them to somewhere else. It works, it works wonderfully. It actually works so well that I guess like the US decided to sanction it because it worked so well and they couldn't trace where the funds were going. But that is not that's not the way that people are going to be getting privacy on chain, I think, or at least most people. I think most people are going to be using things like stealth addresses where it's just built into their wallets and just easy for them to use. Imagine there's a toggle, like, do you want this to be private or do you want this to be public? And imagine the costs I mean, I'm not going to say the cost could be the same. I think that the whole point of stealth addresses might be that the cost can be very similar, because cost has actually been a big issue around privacy before, is that it's normally more expensive to do anything privacy preserving on chain because it requires more computation to do that. But obviously with the advent of things like layer 2s, that collapses the cost down, and we have layer 2s like Aztec working on fully private kind of layers here. But when you kind of think about it from the end user perspective, and if they've just got a toggle between like, do you want to send this transaction privately or do you want to have it publicly? I feel like most users would just select privately, right? Like, and honestly, like a lot of wallets may end up just having it as the default thing, and then it's buried in the advanced advanced settings of the wallet. So in there's just a simple interface, it's always private by default. But then if you want to change it to public for whatever reason, maybe you want to have it public on your public address because you want to flex some NFTs that you're, trading or something, or maybe you're trying to psy up the market by moving money around and making it out as if you're selling or buying when you're not really doing that, right? There are reasons why you don't want to be kind of like hiding your transactions, but I think for most people, they definitely would want to be kind of preserving the privacy of their transactions, especially if they're sending, relatively large sums of money around, and that's just not what we have today. Besides Tornado Cash and maybe some other kind of very small mixes here and there, we don't have anything like that on Ethereum today, but it looks like we just may in the kind of near future, hopefully. So yeah, I guess kudos to Tony for highlighting this, and Georgios for putting this out. Definitely something to think about. All right, so a lot of you have been wondering when the various L2s, or I guess like various rollups, are going to be taking advantage of AIP 4844 blobs. Like, will it be day one when they go live as part of Denkun, or will it be the week after? Will it be the month after? Well, Wesley here has been tracking each of the L2s, or each of the rollups here, and basically has a list here of the ones that are going to go live on day one. So it's already confirmed that Arbitrum 1, ZK Sync, and Starknet will be using blobs from day one. A few days after will be Optimism, Base, and all the OP stacks and super chains. And he said here, not ready yet is Scroll. And then you can see the sources that he in his tweet. But then there's also a few replies here from people like Toggle from Scroll saying that they should be ready in early April, so 3 to 4 weeks after activation. Tycho will be going live pretty soon after 4844, and a bunch of other kind of replies here like Fuel Network will have support at launch, and so on and so forth. So yeah, I mean, I think for most people the most relevant are obviously Arbitrum and maybe Optimism right now, because they're the most I guess like used L2s, and ZK Sync probably too. But yeah, I mean, they're going to be live like very kind of shortly. And I think there's competitive pressures as well, because if Arbitrum 1 goes live, right, and then their fees drop like by, I don't know, drop by like 90% or something. I'm just throwing out numbers here. Obviously, you guys know that we don't know the exact amount it's going to drop by, but let's say, Arbitrum drops by like 90% and then Optimism is still the same. Well, obviously there's a competitive pressure now where Optimism is like, oh my God, we have to do this, right? We have to drop our fees because Arbitrum is so much cheaper than us now. So I think we're going to see that kind of play out relatively quickly. But honestly, I would say most of the rollups are going to be supporting blobs within at most a month from them going live. So it's still going to be a long wait there at all. And I think that it's going to be super exciting to actually see what the fees look like, right? And I've said before on the Refuel plenty of times that we're going to have when it first goes live, obviously, and then we're going to have like the weeks after and the months after, and we're going to have to do a kind of analysis on that and see what the average fees are to get a clear picture of the impact of 4844. And I'm also very curious to see what the impact is on layer 1 gas, like L2s or rollups. they still don't take up that much of L1 gas. I think at most they take up like 10% of all L1 gas usage per day. So there's still 90% that's used by just L1, right? Not by any of these L2s or rollups. So it's going to be interesting to see what happens there. Like our gas fee is going to go down by like 10% or something. I mean, gas fees can fluctuate wildly during the day on L1 anyway. So I think that's just going to be a wash, to be honest. I don't think you're going to be able to like point to any kind of specific kind of lowering of fees, and there is that concept of induced demand there on layer 1 too, and layer 2s as well, but more pronounced on layer 1. But yeah, that's kind of like how I view it, and I'm just really excited to see how it's all going to play out there. But yeah, kudos to Wesley here for putting together this list. All right, so I remember I talked about this, I think last week. Justin Drake has started a new Ethereum sequencing and pre-confirmation call series. So there was pre-confirmation call number 1, and here there's a video that's now shared, as well as a bunch of notes that were taken. And there was a 15-minute technical presentation with a 45-minute Q&A. So if you're interested in learning all about that, I'll link it in the YouTube description below. But I just wanted to shout this out to put it on your radar, because you may have missed it here. But yeah, the notes and the videos, everything will be available in the YouTube description below. All right, so I came across this stat that I kind of worked out today, which was kind of crazy. I mean, I've worked this out before, but I was just thinking about it today. I'm like, you know what? Let me work it out again. So I put out this cast on Farcaster where I said almost 31 million ETH is staked, which is about 25.7% of the total ETH supply. This is $90.8 billion worth of ETH, which is larger than every other smart contract layer 1's market cap. ETH as an asset is in a league of its own. Like, just kind of think about that for a second, guys. Like, just the ETH staked, and it's only 25% of the total ETH, mind you, right? There's still 75% that isn't staked. So just 25% of the ETH that is staked, 31 million ETH, is worth, let's say, $91 billion. The next closest smart contract platform is Solana, I think, at $48 billion, right? So I guess like the amount of ETH staked is almost double the total market cap of Solana there. And then you can go down the list and see the other ones like Cardano at 22 billion, Avalanche at 14 billion, and so on and so forth. And the reason why I wanted to highlight this is because it really just shows like how ETH is an asset, is in its own league, right? It doesn't even have anything that holds a candle to it in terms of value. I mean, ETH's total market cap is $350 billion, which is more than the combined market cap of all the other layer ones put together, and then some. I mean, I think the combined market cap of all the other layer ones put together, I don't know exactly what it is off the top of my head, but I think it's like 100 billion, and even if it's like 150 billion, that is still way less than 350 billion. That's still, you know, less than half than 350 billion. That's all of them combined, right? But then you just look at the amount of ETH that is staked, and it is way less than these other networks, because and these other networks have delegated proof of stake, which, you know, obviously you can just like delegate your stake in. It's not, in my mind, real staking, honestly. I feel like it's just like a fake staking. I've always thought that about delegated proof of stake, but there's that, right? And also these networks don't really, their assets aren't really used for much other than staking. So they have high staking rates, but their values, their market caps are very low compared to something like ETH, because ETH is obviously used for things beyond just staking. I mean, it's used for so much more than staking, right? But just the staggering difference between the numbers here is something that I wanted to highlight for you guys. And it's something that I also like to highlight when people say, oh, you know, all these other things have been outperforming ETH over the last 6 months or whatever it was. And I feel like saying to people, I'm like, yeah, but do you realize just how big ETH is as an asset compared to these other things? I mean, you're comparing $1 to $10 billion market caps to something that has a $350 billion or $300 billion market cap. It's obviously going to require a lot more money to move ETH in either direction. And that means that, like, in a bear market, for example, ETH performs better, and it has performed better than these other things. I mean, these other things that have performed better than ETH over the last 6 months got absolutely destroyed in the bear market. They went down like 95+%, guys. ETH only went down around 80%, I believe, from memory. Now, obviously, me saying ETH only went down 80%, these other things went down 95% is funny, but there's a staggering difference between 80% down and 95% down. So let me just illustrate this for you. Say you put $100 into something and it goes down 80%. you have $20 left. If you put $100 into something and it goes down 95%, you have $5 left. And I know this might seem silly for me to explain to you guys, but that's the staggering difference there. You have 4 times more money left going down 80% than you do going down 95%, right? And you can increase the numbers and make it look even worse. Like, say you put $1 million in. Well, you've got $200,000 left if you lose 80%, and then you've got $50,000 left if you lose 95%, and then it just keeps getting exponentially worse from there. Like, so if you go down 99%, you have $1,000 left, right? $10,000 left. So when you think about it kind of from that perspective, there's a staggering difference between that. And ETH really is a much stronger asset on the downside, but it also obviously it is potentially weaker over the short term on the upside because it takes a lot more money to move it, but it is just like so much more valuable than these other things. So yeah, just something to keep in mind. And I obviously think that the amount of ETH that is staked is going to keep going up. I think that with the advent of restaking, with the advent of a few other things coming online, the amount of ETH staked is probably going to keep creeping up all bull market. And then it's going to be really interesting to see what it looks like maybe, I guess, 6 or 12 months into the bear market, because there will definitely be a blow up at some point, guys. Like, the bull market gets too crazy. People blow themselves up on leverage. We probably see some LSTs, I mean, it's not technically a D-peg, but we probably see some LSTs and LRTs coming off of their fair value. And then everyone's trying to do arbitrage and trying to make profits between that. But really, it's the little guy that gets wrecked because they don't know what they've gotten themselves into. They don't know the risk that they've taken on. So there's going to be a lot of volatility there. But I don't know how, like, what the net result will be for the amount of ETH stake. Like, are we going to see like a mass withdrawal from the beacon chain? We'll have to see, right? ETH staking has not existed in a bear market, in a full bull and bear cycle the way it exists today, because it launched December 1st, 2020, like halfway into the last bull market. But ETH staking was very closed off back then. There wasn't really much ETH at stake at all. There weren't really many options to stake. It was a solo staking, or you could go with some centralized exchanges offered it, it's like Celsius offered it, I believe, really early on. But we all know what happened with Celsius. And then Lido came along, but really it's built up a lot over this bear market. So now we get to go through a whole bull market. We have restaking, which is new as well, and a few other things which are new. And then that will, of course, flow into the bear market, and we'll have to see just what happens there and how much things get blown up there. I mean, I don't want it to happen, but I kind of know that when the mania hits, people lose their minds and they lose their kind of, view on risk, and they kind of just keep going out the risk curve because it feels like you're going to be making money forever, and that's definitely not the case. But yeah, we'll see. We'll see what happens there. But anyway, enough on that one. I'm going to move on to a topic that I wanted to spend a fair bit of time on today because I saw a lot of people talking about this, and it's Ethena. So you may have heard about this project on Twitter today, Ethena, which I have talked about a bunch on the Refuel before. You guys know I am an investor in Ethena here, but the reason why people are talking about them today is because they launched their public mainnet, and they have a kind of points campaign going on as well. Now, the reason people are talking about them is, I guess, because a lot of people are comparing Ethena to Terra. And the reason they're doing this comparison is because Ethena has basically said that they're going to be offering 27% yield on their stablecoin, which is USDE. Now, of course, and naturally, especially given that we saw Terra blow up after offering 20% yield on UST, everyone's suddenly like, oh my God, we just reinvented Terra. It's a new Ponzi. How can you be offering 27% yield? So on and so forth, without actually understanding what the actual product is. So what I want to do today for a few minutes here is I actually want to run through what the product is. I want to explain to you how it's different to UST, and I want to explain to you how it's completely different when it comes to failure cases to something like UST and all the risks involved. But first, I have to obviously disclaim and disclose I am an investor in Ethena, but as I said on my tweet here, I put a small check in because I liked the founder and thought that the idea was worth pursuing. And I do want to say that the small check I put in, I'll put a dollar amount on it. It was $10,000 US. That is small for me. Like, I'm not trying to brag or anything like that, but that is what I consider small in terms of like what I invest, in terms of angel investments or public market investments. That is a very, very small check for me. I put that in because I really like the founder. He's a super smart guy, very honest. Like, we got along really, really well. He's always open to feedback. He doesn't have an ego about him. Like, I just really liked him. I'm like, you know what? Like, I can see where there's a lot of issues with, or a lot of potential issues with something like Ethena. And one of the first questions I asked him on the call that I had with him was like, is this collateralized? Because that was like my biggest thing. Because as soon as I heard of this, I straight away went to Terra as well. I'm just like, okay, I know what happened with Terra. I'm going to be careful with this. I'm going to actually kind of do my due diligence here and investigate what's happening. And that was basically one of the first questions I asked. And it is, but I'll get into that in a sec here. I also put out in this tweet that I said that I'm happy to see people actually questioning Athena's claims, because it means that we're getting healthier as an ecosystem. It means that the ecosystem is becoming more mature and we're not just taking these things at face value, we're actually questioning them. So in saying all of that, now we'll dive into exactly what it is. And I think the first thing I need to explain is, where does that yield come from? Where does that 27% number come from, right? Well, it's broken up into two different parts. There's 4%, which is the ETH staking yield. So USDE is collateralized with STETH, partly collateralized with STETH, which is offering currently around 4%, right? So that's the ETH staking yield. And they plan to expand to other LSTs and LRTs and so forth. But right now it's just STETH. So that's 4% there. And then the other 22% comes from the funding rates on centralized exchanges that people are paying to be short on ETH. Now, currently that's 22%. Now, that can fluctuate, so can the ETH staking rate, right? So this 27% number is not something that is guaranteed to last at all. This could go down a lot from here, right? This could go down to negative, actually. That's the way funding rates work on these perp exchanges. And now, in saying that as well, I want to make clear here that the USDE stablecoin is not decentralized at all. It uses centralized counterparties. It uses the centralized exchanges in order to pass that funding rate, or at least kind of wrap that funding rate up into this stablecoin. So a better way to think about USDE is not as a decentralized stablecoin, but as a centralized stablecoin that is trying to compete with USDC and USDT, while also offering a yield to the people holding it and to people using it. Because as you guys know, the way Circle and Tether make money is that they just have dollars and treasuries and other similar assets in bank accounts backing their stable coins, but they keep all the yield for themselves. And this is why Tether is, I believe, the most profitable company in the world based on a per employee basis. They don't have that many employees, but they make a lot of money because right now they're getting paid, that risk-free rate from the Fed and from holding US treasuries, right? And they're getting paid like whatever it is, 4%. I don't know off the top of my head whatever it is right now on Tether's market cap, basically, which is almost $100 billion. So they're making a lot of money, right? And so is Circle with USDC, even though USDC is smaller, but they're not passing any of that onto the user. So when you're holding a USD stablecoin, you're getting nothing on it, just holding it, right? You can obviously put it into a money market or lend it out to someone maybe they'll pay you interest or whatever. Obviously, you can do that stuff, but just holding the coin itself gives you nothing. Whereas the whole idea with USDE from Ethena here is that it breaks these kind of like perpetual funding rates and the ETH staking yield into this to give you a really nice outsized yield here. Now, of course, there are a lot of risks associated with this, guys. Like, I'm not going to sit here and tell you that there aren't risks associated with it. There are. First and foremost, one of the biggest risks, I think, is the fact that it relies on centralized exchanges. So if one of these centralized exchanges was to, I don't know, go under for some reason, right? That would mean that it would technically be under collateralized. I don't know. I wouldn't say that that's like completely correct terminology, but it would mean that essentially there would be a hole, right? There would be a hole to be plugged because of that. And also not just a centralized exchange blowing up, but let's just say there is a massive unwinding event of positions where there's not enough liquidity to meet those positions, and then people blow up and people end up owing money, and then it needs to be paid out of some kind of insurance fund, which we've actually seen happen on places like BitMEX. BitMEX has a very large insurance fund that's denominated in BTC, and whenever there is some kind of like a massive blow up or something goes wrong, maybe the exchange kind of has a bug in it or has a glitch in it where the pricing's wrong, whatever it is, they use that to cover the losses there. So that is another risk here. Another big risk, which is very, I guess, like native and very unique to sorry, I shouldn't say very unique to USDE. I should say not unique to USDE is STETH depegging, so to speak. So let's just say we get the repeat of what happened after the Terra collapse, ironically, after the Terra collapse in 2022, where STETH actually traded at a discount to its fair value. I think the discount was 0.9. So you could buy 0.9 STETH and then you could get 1 ETH from the beacon chain. But at the time, there was no withdrawals enabled on the beacon chain, so you couldn't actually do that arbitrage. But now there is. So I think that the kind of like depeg will be less steep because of the fact that you can do this active arbitrage, but at the same time there is still a possibility of that happening in an unwinding event. So really, most of the risks are centered around the fact that there can be mass deleveraging events in crypto that we've seen time and time again that can lead to bad debt in the Ethena protocol, because it's basically a wrapper around the centralized exchanges, around things like STETH, and that can lead to eventually losses for end users here. And the other big risk is that if funds go negative and they stay negative for too long, it essentially means that I'm not going to claim I'm an expert on what can happen here, but it essentially means that you're basically losing value because you're not getting 27% yield anymore. You're getting like negative yield essentially, and you're basically bleeding value out from there, and the protocol is bleeding value out from there. And unless the funding rates go positive again, the whole system, I think, runs the risk of becoming, again, under collateralized, probably the wrong term here, but basically having a debt that it owes here. So those are the major risks. Now, at least from my understanding. There may be others that I'm not aware of here. Ethena actually has a really, really great website, a really great FAQ section, a really great documentation section where they go through all of this. So I highly recommend checking that out. I just realized I'm at 30 minutes. Wow, I went for a while there, but I really felt that this was important to explain to you guys. Just the last thing I want to say about Ethena here is that when comparing it to Terra, the reason why I think that it's a really dumb comparison is because, and specifically UST, is because UST was pretty much like almost all of it was under collateralized, and it completely relied on an algorithmic Ponzi mechanism to basically stay collateralized, because as UST depegged, more Luna would be printed, and then you'd sell off the Luna to repeg UST. But if UST never repeg, never went back to $1, you just kept printing more Luna. And then what happens when you keep printing more of that token and selling it into the market? The price keeps going down, right? So you have this death spiral that ends up happening here. So the thing that killed Terra was that point of it, that kind of like death spiral, but also the fact that it was just under collateralized. Whereas in this case, unless something was to break, unless a centralized exchange was to go offline, or some kind of bad debt was to form because of some mass deleveraging event, or the LSTs that they're using depeg for long periods of time, because it can always repeg, right, and it could be okay, then it won't become under collateralized. It won't accrue bad debt. It will essentially fix itself, so to speak here. But those are the main risks as I see them, and why they're definitely not the same thing as Terra here. Now, in saying all of that, please do not get involved with this protocol unless you know what you're doing. You need to do your research on stuff like this, guys. Like, I know that a lot of you are not traders. A lot of you do not understand how funding rates work, how perpetuals products work. This is a very new protocol here. I know it may seem exciting to get involved with it because they've got an airdrop campaign. You might get a token airdrop later down the line or something like that. If you want to do that, if you want to be a degen, as we say, do it with a money that you can afford to lose, because this is brand new stuff. It's untested at scale, and it definitely carries a lot of risks with it. So that's my only kind of like plead to you guys, is that please make sure that you know what you're getting yourself into if you go into this. And I've done my best to explain the risks here. You guys know I'm an investor, but hey, like, as I said, I'm invested because I thought the idea was interesting. I really like the founder, but my investment in it should not be taken as an endorsement. It should not be taken as something that you have to go ape into because like it's backed by Anthony. He knows what he's talking about, let's ape in. No, please, none of my investments are like that. Like, I'm taking the risk by putting money in, obviously. I'm taking reputational risk as well by putting my weight behind this sorts of stuff. That's the risk I'm taking. But, I'm taking that with the knowledge that I could lose. I could lose on this, and then I lose my money and I take a reputational hit. And honestly, every time I do an angel investment, I actually mentally write it down to zero. I have a spreadsheet where I track everything. I know exactly how much money I've put into all of these things, how much money I've made from them so far. But I basically write down every single one to zero from the moment I put it in. I don't write it down officially. Obviously, if I wrote it down officially, I'd have to do it on my taxes and things like that. But mentally, I say, okay, I put money into this. I think it's a cool thing, a cool idea. I like the team, so on and so forth. But it is worth zero until one day I get some tokens, or maybe I get some equity here, or maybe the company gets acquired and I get a share in that, whatever it is. But because they're early stage investments, because I understand that they're very risky, I do the mental thing of writing it off to zero. and then whatever happens, happens. Whereas if you're investing, in this stuff and putting your money into it and putting it in, say you put like $1,000 into this protocol because you want to try it out, because you want to airdrop farm, just come to terms with the fact that you could lose all of that, right? Based on either the underlying mechanisms of any protocol they interact with, or based on smart contract bugs, and so on and so forth, right? Or hacks and things like that. So I think that's just my final piece of advice there. And as I said, I've gone overtime here. Just wanted to say that there's another tweet from Connor Ryder, who is the head of research at Ethena, that does a great job explaining all the things I just explained in a better way, with nice little graphs and charts for you to look at. So I'll link that in the YouTube description below. I definitely highly recommend reading that. But as I said, the Ethena team is extremely open to feedback. They have always been great whenever I've talked to them. Mostly the founder, whenever I've asked questions. I think they have a Twitter Spaces going on Thursday as well that you can ask questions on. But they have a Discord channel that you can join too. So definitely, if you have questions, if you have feedback, go let them know. There's no egos there, guys. Like, I have not felt any kind of ego coming from the founder of Ethena. And as you guys know, I hate people with egos. Like, I steer clear of them. And that's honestly a major reason why I'm so excited for Ethena, is that it is something that is untested. It is something that could go wrong based on all the risks I outlined. But it's something new and interesting. It's something that I think it falls into what I want to see in DeFi. Like, you guys know that I've been talking about wanting to see more innovative stuff in DeFi. And as long as the risks are disclosed, as long as the team takes the feedback on board and they aren't egotistical about it and all that, I think it's fine. But yeah, I think that's true for what Ethena is doing. But as I said, you can read this tweet, go join their Discord channel, and get to know what they're doing here. All right, just last up quickly, just wanted to shout out that the Daily Gwei Farcaster channel hit 1,000 followers today. So thank you everyone for following the Daily Gwei channel on Farcaster, and obviously following me on Farcaster as well. It's shaping up to be a really nice channel. We have a lot of great posts in here, some conversations, some feedback on things, people posting things like this sticker, ETH is money sticker, that is on someone's car here. This was actually a sticker that was done under ETH Hub ages ago. So it's kind of like OG here. So yeah, it's just like a cool little channel for the Daily Gwei community to hang out in. Obviously there's a Discord channel as well. The link's in the YouTube description below to that. But yeah, just wanted to give a shout out that we reached 1,000 onto 10,000 next, right guys? But anyway, on that note, that is a really long episode for today. So thank you everyone for listening and watching. Be sure to subscribe to the channel if you haven't yet. Give it a thumbs up, subscribe to the newsletter, join the Discord channel, and I'll catch you all tomorrow. Thanks everyone.